When you woke up this morning, you almost certainly used a Procter & Gamble product before you even had your coffee. Your toothpaste, your shampoo, your laundry detergent. P&G is this quiet giant in our daily lives. But how is that giant really doing? Well, their latest numbers tell a pretty fascinating and maybe even surprising story. So let's dive in and try to piece together this P&G puzzle.
And we are talking about some of the biggest brands on the planet. I mean, Tide, Gillette, Pampers, these aren't just products, are they? For millions of us, they're the default choice, the names we've trusted for generations.
And the sheer scale of it all is just mind-boggling. Their empire covers everything from baby care to beauty, from fabric care to healthcare. It's a portfolio so massive that it touches pretty much every room in your house. So really, when we look at their financials, we're kind of taking the pulse of the global consumer.
All right, first up, a titan of households. We're going to start by taking a big picture look at the company's overall financial health.
And that leads us to the headline numbers from their latest quarter. We're going to break down what these huge figures really mean for the business and for all of us.
So, the company CEO, John Moeller, put it this way. He's basically saying, hey, we know things are tough out there for everybody, but we feel good about our strategy. So let's see what that strategy actually produced, shall we?
Okay, before we get to the main number, we have to quickly define a key term you're going to hear a lot: organic sales. Now, this is the number Wall Street really obsesses over because it strips away all the noise from things like currency changes or buying other companies. It's the purest look at how the core business is actually performing.
So, the big headline number, the one everyone was waiting for. P&G's organic sales growth came in at 2%. Now, for a company this massive, 2% sounds pretty steady, right? But the real story, the interesting part of the puzzle, is how they got to that number.
And this, right here, is the crucial piece. That 2% growth didn't come from selling more stuff. Nope. It was driven by two things. 1% from just straight up raising prices, and another 1% from what they call a favorable mix, which is just a fancy way of saying they convince people to buy more of their expensive premium products. But notice what's at zero: volume. The actual number of items they sold was completely flat. They didn't sell more things. They just sold them for more money. Okay, so let's dig a little deeper, because P&G is really a collection of giant businesses, and they definitely did not all perform the same way. The results were, they were all over the place. The clear star of the show was the beauty segment. We're talking Olay, Pantene. It grew a really strong 6%. And what's great here is that this was healthy growth. It came from both selling more products and bringing out cool new innovations, especially in hair care. Next up, we've got grooming. Think Gillette and Venus. This division saw a solid 3% growth. The story here was really all about pricing power, particularly in North America and Europe, where they were able to raise prices and make it stick. Healthcare, which has huge brands like Crest and Vicks, grew by a much more modest 1%. It was a bit of a mixed bag, really. Oral care was flat, but the personal health side grew, and yep, you guessed it, that was thanks to higher prices. Now we get to one of the absolute engines of P&G's entire business, fabric and home care, with titans like Tide and Dawn. And this whole division was completely flat. 0% organic growth. A little dip in fabric care was basically canceled out by a small gain in home care. And it is the exact same story for baby, feminine, and family care, also flat. 0%. Some growth over in baby care with brands like Pampers was totally wiped out by declines in family care products, like paper towels. And this chart really puts the whole challenge P&G's facing into perspective. It shows the change in their global market share. For years, you see all those green bars, just steady growth. But look at the more recent trend, more and more red bars showing declines. This quarter, their overall market share actually slipped by 30 basis points. Now, that might not sound like a lot, but it suggests that while they're getting us to pay more, they might be losing some shoppers to the competition. So, with that performance behind us, let's look forward. What is P&G telling investors to expect for the rest of the year? Well, P&G is guiding for pretty modest growth. They're telling everyone to expect organic sales to be anywhere from flat to up 4%. But what's not modest is the cash they're giving back. They plan to return a massive $15 billion to shareholders through dividends and stock buybacks. But, and this is a really big but, they are staring down some serious headwinds. They've already baked in $500 million in hits from things like tariffs and higher commodity costs. And on top of that, there's a whole list of other huge risks, from a slowing market to global turmoil, that are not included in their official forecast. So let's wrap this all up. After all those numbers and charts, what's the one big thing, the main takeaway from P&G's quarter? It really all comes back to this chart. P&G's growth right now is not coming from selling more diapers or more razors or more detergent. It's coming entirely from getting you and me to pay a higher price for the stuff we already buy or to trade up to a fancier version. The actual volume of goods they're moving is completely stagnant.
And that leaves us with a really critical question. P&G is making a huge bet on the power of its brands. They're betting that we'll all keep paying more for Tide or Gillette no matter what. But in this tough economy, with every competitor fighting for every single dollar, you just have to wonder, how long can that strategy really last?